From downtown Milwaukee, welcome to Money Talk with Bob Landis. Each week, professional advisors from Landis & Company Investments discuss the latest financial developments, offering timely insight and long-term perspective.
This is Money Talk for June 14th, 2024. Let's check the calendar. In case you snuck up on you, it's Father's Day this Sunday. Don't be cheap. Your Milwaukee Brewers are home this weekend with the Cincinnati Reds, and then there's the Lakefront Festival of the Arts and Polish Fest at the Summerfest grounds. Or you can just let the old man nap on the couch. Okay, let's start in Florida, where book banning seems to be all the rage. The Indian River County School Board has banned a book about book banning. Obviously, they already banned the book that explains irony. Okay, we're off to China, where they paint dogs to look like pandas, where they put a man in a bear costume at the zoo. Well, they're at it again. The flow of water from China's tallest uninterrupted waterfall is coming from a pipe built into the rock face. The man-made waterfall is a tourist attraction for all the wrong reasons. And from Texas, we get this one. Austin police arrested a suspected car thief. He said his name is Optimus Prime. The character from the Transformer movie is sitting in jail with an $8,000 bond. You'd think a big movie star like Optimus Prime would cover that. And finally, Norway has petitioned to create a time-free time zone on one of the islands that has daylight for 2 straight months. My wife would love that. She says that without clocks, you could never be late. Oh, I think she'd find a way. On the podcast today, we have Dave Sandstrom, Tom Pappenfuss, Joel Driesing, and wrapping up the week, here's Kyle Tedding.
Well, thanks, Max. Right on time for a strong week for the NASDAQ and the S&P. The NASDAQ up 3.2%, closing at 17,689. The S&P closes at 5432 on the week, up 1.6%. Unfortunately, not quite as good of a week for the 30-stock Dow Jones Industrial Average, down 210 points after dropping 58 on Friday to close down 0.5% at 38,589. For the year, the Dow up 3.2%, the S&P up 14.5%, and the NASDAQ up 18.2%. You know, Dave, I think the place to start this week so clearly with the Federal Reserve on Wednesday, a strong reminder for investors that I think we're early in the year pegging hopes on a rate cut, trying to time what that would look like, that it does appear that timing the Fed's actual moves just continues to be impossible.
Yeah, I would put that right in the fool's errand category, Kyle, because I think, boy, just looking back over the last several years, one of the quote-unquote surest bets, of course, was coming into this year that the Fed was going to be aggressively cutting rates. I mean, the market had, I think, priced in 6 to 7 cuts this year. What I think is interesting about it, if you look globally, at that point in time, beginning of this year, we were so far ahead of the other central banks. And, boy, I tell you what, 6 months later, and all of a sudden, we're thinking maybe we won't cut rates, and some of the other central banks already have. So, yeah, you're right. I think it's pretty tough to figure out the Fed in advance, and it just points further to the difficulties in forecasting interest rates.
Well, and I think the benefit that we now have is that rates are a little bit higher, and I think we viewed that for a long time as almost punishment for those that maybe were debt financing. Certainly the goal was to slow things down, and now, Tom, we're starting to see maybe there is some benefit to those higher rates. Maybe we're seeing some economic impact of investors having a little bit better opportunity for safe money.
Yeah, I mean, right now we're still seeing the results of what continues to be mixed data. With respect to interest rate, we're seeing the economy looks like it's growing faster than expected, and then perhaps slowing, seeing less payrolls and job numbers, and then we have inflation that's ticking up and now it's ticking down. It's hard to peg, and you're never going to get it right. And oddly enough, the point of the restrictive or higher interest rates to slow things down and ultimately to fight inflation, you can also make an argument. You can make a case that the higher rates has been beneficial. You think about, we are kind of a debtor's nation, right? It's our government, with the amount of debt they've issued, obviously there are people on the other end that are holding that debt and receiving higher yields as a result of that. That means they have more cash in their pockets to spend. And so there is, when you look at the actual numbers, I believe last time I saw here was that U.S. households have about $13 trillion in short-term assets and about $5 trillion in consumer debt. It's estimated that could lead to about a $400 billion a year surplus in net gains for households, and so it just tells you that on the other side of the higher rates there are people receiving that interest. And heck, just look at retirees and maybe the baby boomer generation. They tend to have the most savings right now, right? They constitute approximately 20% of the consumer spending right now. They have more money to spend, and so we're kind of seeing that. Well, it should be more restricted, but people have that extra money, that extra cash to put back into the economy.
One of the biggest bond managers in the country, PIMCO, came out with a study looking back over the last 50 years of the Barclays Aggregate Bond Index and what really was the primary motivator for expectations for future returns. You look on rolling 5-year periods, the current interest rate on that Barclays Aggregate benchmark index was 94% correlated to the returns you got over the next 5 years on that same index. And so I think what it's telling me, the story we've been telling now for 2 years, is higher rates aren't bad. The act of getting to higher rates hurt a little bit, but higher rates overall actually give us that better opportunity. And if rates are now higher, our expectations for returns should be higher as well. And so it shapes the conversation a little bit for me on where do we invest, where do we choose to invest. It means our safer money actually does look a little bit safer. It means we don't have to take as much risk. And where we take risk, we want to make sure we're getting paid for it.
Kyle, I think that's a really critical point. What we have seen happen in the last 18 months is we've seen that risk premium, what we would refer to as the difference between what you're getting paid on something safe like a 10-year Treasury and the S&P 500 return, has shrunk considerably from where it's been over the last 10 years. And we were looking at double-digit risk premiums being paid out the last 10 years, and now that's going to be largely compressed. Now, what that means is it's going to, I think, start to reward the conservative investor. It's going to benefit balanced portfolios even more because you're not relying so heavily on the stock market to provide all of your return. And I think it's critical for investors to embrace that.
Yeah, I agree. And, we kind of started the conversation today on the Fed, and coinciding with the Fed's announcements on Wednesday, Joel, we had data on consumer price index, such a critical component. Even if it's not the Fed's preferred measure, it's certainly the first inflation measure I learned when I studied economics. And so I think it is something that is pretty closely followed. The Fed certainly talked up the role that it played in some of their decision-making, and news that maybe inflation is doing what we hoped, if not quite to the target yet.
Yeah, Kyle, it's showing that the economy is continuing to slow down. As Tom said, that's the whole point of the Fed raising interest rates almost 2.5 years ago now already, is to slow down the economy. But the economy isn't slowing down enough that the Fed can afford, or feels that it can afford, to take its foot off the brake. So we got the numbers on Wednesday, and it showed more progress in slowing down the economy. The year-to-year inflation rate from the Consumer Price Index, which is the broadest measure of inflation, was 3.3% from a year ago, and that was decelerated for the second month in a row. It's down from, remember, it was 9.1% back in June of 2022. That's the highest it had been in like 40 years. So that's progress. It's still, though, not the 2% that the Fed wants long range for inflation, but it's closer.
And I say this almost tongue-in-cheek, but I read a good article today pointing to the month-over-month change on core consumer price index, which came in at 0.2%. But when you look deeper than just the rounding error of 0.2%, the actual number was, if you annualized it, almost precisely a 2% annual rate of inflation. judging by 1 month, judging by one measure of inflation. And the article writer was suggesting, well, maybe the Fed's hit the target. And I think, we joke on here about how easy it is to say whatever you want to say about inflation just by cherry picking that one data point. But I do think it is a feather in the Fed's cap that while we aren't back to 2, we are still headed in that direction. And then, Dave, I know you've looked quite a bit at longer-term inflation rates, and maybe 2 is not even the number that we need to be at long-term. It certainly isn't the number that we've seen historically.
Yeah, Kyle, I guess I'm probably not smart enough to be a Fed chairperson, but I've always kind of questioned why we picked 2% as the target. Obviously, pretty low. And if you really look at the long term, you go back to 1950, the average inflation rate in the country is somewhere between 3.5% and 3.8%. Now, we did come off of a very low inflation period following the financial crisis. We actually had several years where inflation was about 1% and even a few where it was actually less than 1%. So that brought those numbers down significantly. But what I find interesting is during that time frame, the Fed's goal was we have to get inflation up to 2% because of the fear of deflation. That's why I thought it was peculiar that they chose 2% as the target on the way down. So, 3.3, 3.4% inflation, historically speaking, doesn't seem alarming to me.
Well, I think the question comes back to, right, what's the magic of 2? I had a client a lot smarter than me this week ask that very question. Why did the Fed pick 2? The reality is I don't think the Fed did. It, depending on who you believe, went back to the New Zealand central bank and looking at an inflationary environment the late 80s, early 90s that was far, far higher than 2. They wanted some number that encouraged spending, not strictly saving. But the teens that it was in New Zealand at the time was far too high. And so, the finance minister at the time essentially said, 2% is probably the right number, and it just stuck. And then other global central banks started piling into that conversation. Bernanke in 2012 finally kind of rolling it out for our own central bank and saying, hey, maybe that's the number we're supposed to be shooting for. But it wasn't a political mandate. It wasn't written into the Fed's rules that 2% was the target. It's just the number that they kind of settled on as this is a number that encourages a fair amount of spending over time without being too high that you allow prices to run out of control. And so I think it's interesting how we get there. I don't think it was ever intentional.
And my understanding, too, is that because we're such a big economy and such a mature economy, that we don't need to grow as fast as a place that's smaller. So,
well, 2% of a large number is a much larger number than 10% of a very small number. And so I think when you're already as big as you are, it's hard to grow that fast, first and foremost. And then you add in, well, okay, we are a fairly fully mature economy. I'd argue we're going through a renaissance right now in terms of our own economic development, but even still, growing at 7 or 8% is pretty tough to do.
And we are a lot bigger than we used to be too. So as far as that's concerned, but also this week we had the World Bank pointing to the U.S. and saying because the U.S. is growing so well, we're upping our forecasts for the whole global economy. We think that the global economy is going to be growing faster in 2024 than we thought back in January, just because the U.S. is doing so much better than we thought back then.
Well, we are, and yet, when you look at consumer surveys, and Jay Powell talked about it this week, and his comments following the Federal Reserve meeting, we got data today on the Consumer Sentiment Index, still far weaker than we would hope.
Yes, it's the preliminary number for the June index from the University of Michigan on consumer sentiment showed that it's pretty steady, significantly, marginal from May, but that it's 31% above its all-time low, which was just, again, 2 summers ago. But historically, sentiment is pretty low, and people are pretty wary, especially of prices, and the effect that has on their psyche and spending. And we know that consumer spending accounts for 2/3 of our gross domestic product.
Well, and Tom, I know just from an investment perspective, sentiment sometimes weighs on what we're looking to do, and I'm sure you see that in some of the data and some of your conversations.
Yeah, I mean, a lot of conversations I think right now that I have, and maybe you two can relate, is the market's come a long way again this year in a short period of time. So it's kind of like, okay, well, when's the next shoe going to drop? So people get a little worried about, well, should we be doing anything different? And what's interesting is the information or the data is mixed. It's very mixed, similar to what we see on an economic front. It's the same way as it relates to investing. What I mean by that is you've got, I think the investor sentiment surveys are showing that about 39% of people are bullish, I think, and then it's about 36% are bearish, and then about 26%, I'm sure that math isn't correctly at, but are neutral. But it just tells you that we have a nice mix of people that I think the markets can do well, and that's further supported by, again, more mixed data that when you're looking at cash flows, I believe the number was about 11 billion flowed into stock funds in comparison to about 48 billion has flowed into cash funds. So you see a little bit more people going into cash, not quite as much into equities. And so it's on pace to see more money flowing into cash and money markets right now for the year as opposed to equity funds. Why that's significant is, again, kind of relating back to where we think markets can go from here. Is you want some of that mixed. You don't want 100% people bullish. You want a little bit of a mixed environment, mixed kind of indicators out there, so that not everyone is bullish, and then it kind of feels like, well, perhaps that's the top, and the last person's gotten in. So I think there's a lot of room to run here, and some of those mixed numbers kind of support that.
Is that also recognition of what you were talking about before, that cash is paying?
And cash is paying, absolutely.
Yeah,
it's
exactly, Joel. That's where I was going to go with that. It just speaks to the fact that there's not just one game in town anymore with the stock market. I mean, there are places to go where you can make a reasonable return on your safe money. So I think that reduces some of that pressure for investors to feel that, the whole FOMO kind of a environment where that's the fear of missing out. That's, I think, enhanced when your cash is making zero. That you really felt bad when you missed a stock rally. Now it's like, well, 5% is not too bad on my safe money. I can hang out here for a while.
Amazing how some of the old economic conversations on things like opportunity cost come back into play all of a sudden. It was a no-brainer at zero that you put the money to work. It's a lot harder of a conversation if the choice is, well, do I take the 6% coupon on the bond? Do I take the potential 8 or 10% upside on the stock, or do I just settle in and get 4 2/3 on a money market? Well, that's a real conversation as opposed to, do I take the 8 to 10 on stocks, or do I take the 0 on a money market? All day I'm going to take the opportunity. And so I think it really does speak to how much more difficult the conversation is. And the fact that the conversation is difficult actually, I think, speaks to how much better the opportunity set is. The other part, and the part that, Tom, when you were speaking, I kind of fall back on, is with that much still going into cash, I think that fear of irrational exuberance, not terribly well founded right now. You don't see, good money chasing bad money or vice versa. You see that people who should be in stocks are in stocks, and money that shouldn't be there is going to its higher purpose, is going to the place it's supposed to be. And so I think as long as those alternatives exist, you're not going to have the kind of bubbles, you shouldn't have the kind of bubbles that we see when you get pushed into corners of the world where you otherwise shouldn't be.
And that's not only true of the retail investor, that's true of the institutional investor right now, which is kind of what's come to dominate our market. So again, it's the overall sentiment, even on the institutional side, is bullish, but very modestly bullish, like just slightly bullish right now at this point.
And for good reason. We've got these generational shifts in technology. We've got nearshoring or reshoring taking place in some of our manufacturing. Maybe some of our largest manufacturers have some process improvements and some streamlining of production capacity that they might need. But overall, I think it speaks to an economy that already on solid footing has some growth potential ahead. With that, we enjoy doing the program for you. We will talk to you again next week.
Thank you for listening to Money Talk with Bob Landis. If you have a financial question you want answered on next week's show, email it to moneytalk@landis.com. To keep informed throughout the week, visit our Money Talk page at landis.com.